Hi, and welcome to this month's Trade Floor Update. I'm David Orazio, and today I'm joined by Portfolio Manager Adam Bowe. Adam, there seems to be a collective optimism coming into 2021, but the pandemic is worsening in many parts of the world. What is the risk that we see with the vaccine rollout taking longer than expected, and what are other downside risks that we're watching?
Yeah, you're right, David. So, coming into this year, there has been a lot more optimism. But there's still an enormous amount of uncertainty. So as we look at this year, I still think we have to be quite humble with our forecasts. You mentioned the vaccine rollout as a risk, and that's true as we've seen in other parts of the world. The logistical challenges are enormous with these programs, so that's a real risk. I think a big one is fiscal fatigue. Fiscal authorities have been enormous support to growth as we've navigated the pandemic, and there's a real risk that they start to focus on budget repair too early, which would be a huge drag if that occurred during the year. And there's many other risks. I think another important one is economic scarring. This one's really hard to measure and very hard to calibrate, but it's the risk of coming out such a different shock that we've been through, the enormity of it and the nature of it, that businesses and consumers remain much more cautious than we'd expect for extended periods. So room for optimism, certainly, but still an enormous amount of uncertainty.
You mentioned fiscal fatigue as a downside risk. Now, how real of a risk is that in Australia this year?
Well, I honestly think it's a real risk. You just have to look at the history of Australian politics, where really both sides of political divide focus on budget repair and fiscal repair and budget surpluses, and really view that as vote winners. We've got a history of that here, so I think it's a real risk, and you just have to look at current timelines. So we've got a vaccine program that's starting at the end of February at best. And the federal government keeps coming out wedded to the view that JobKeeper, the biggest arm of their fiscal support program, is going to expire in March. So you've got vaccines starting around the same time as the biggest arm of the fiscal support program ending. And we know as we said, from international experience, that vaccine programs take months to gain traction and are really logistically challenging. So there's not a lot of room for slippage there. So I think as we navigate the next few months in Australia particularly, but it's a risk for everywhere around the world, but Australia particularly, as we navigate the next few months, I think there is a real risk of fiscal fatigue, the government tightening the fiscal purse a little too early, and plenty of room for policy area.
Now, despite the downside risks that you mentioned, Adam, we've seen some stronger than expected data of late. Specifically, the labour market has bounced back quicker than many have anticipated, with 90% of the jobs lost with the COVID shock now being recovered. How are we all putting this together in terms of positioning our portfolios?
Yeah, you're right. So we're focused on downside risk, but in reality, our baseline outlook is for reasonably robust recovery in the second half. So the question is how you position for that. We bond fund managers, the temptation is to be running short duration into that sort of recovery. But I think with the risk of fiscal fatigue and central banks around the world very committed to staying on the accelerator in terms of monetary policy support. And in fact, we've just seen the RBA extend their QE program beyond April with another 100 billion worth of bond purchases. I think that technical of central bank support is going to be quite overwhelming. And so I think we're in a reasonably bounded interest rate outlook. So trying to run a short duration just isn't a particularly compelling way to position for recovery in the second half. But there are other opportunities that we really like. So in the credit market, there's still pockets of the investment grade credit universe domestically that have scope to recover. So places like airports, universities in Australia that are still recovering from that pandemic shock. The inflation-linked market's still attractive. Obviously not as attractive as it was, but the break-even spread implied in inflation-linked bonds are still well below the RBA's 2 to 3% target. So that's an attractive place to have some inflation protection in portfolios. And then the currency market as well. So portfolios that can have currency exposures, owning currencies from countries that are quite cyclical in nature. So currencies of Australia, Norway, Sweden that typically do well as global growth picks up, we think is quite attractive as well. So relatively bounded interest rate environment, but a lot of other opportunities, attractive ways to position portfolios to that expected recovery in the second half.
Thanks for your insights today, Adam, and thank you for joining us. If you have any questions or would like further information, please reach out to your local PIMCO account manager or visit our website at pimco.com.au.